I mean, I think, Michelle, all you need to see is the amount of deliveries coming on the COMEX, and I can make it very simple. When I started talking with you about this stuff several years ago, it was about the central banks purchasing gold and the repatriation from the Bank of England and the New York Fed. But now it's progressed to massive deliveries coming on to the COMEX market. Entities standing for delivery for billions and billions and billions and billions every single month for going on 16 months. At this level, that's all you really need to see. To me, that's all that is relevant. The people who are standing for delivery for literally in December, as an example, the largest delivery of silver in the history of the COMEX market in the month of December, somewhere in the neighborhood of 68 million ounces of silver. Who's standing for delivery for 68 million ounces of silver? Every month, 3, 4, 5 million ounces of gold or more. This is going on repetitively, and there is no one talking about it. To me, there's nothing else you need to see. So far in January, which is not a delivery month, I don't know, somewhere around 40 million ounces has already been delivered. I haven't checked it, but I would assume that's about where it is. It was in the upper 20s last week. So even if you take the upper 20s and you add it to the 64, 5, 6 million ounces that was delivered in December, the largest ever, you're at roughly 100 million ounces in the last 45, 50 days that have been delivered. Now, is there any, I think, coincidence maybe that the government classified silver a critical mineral? And they just passed a law saying that the government will put price floors underneath critical minerals within the next 90 days. And one of the things that I find to be shocking, Michelle, is the lack of media coverage of this. None, zero. And that's almost, fine line between conspiracy and reality. But where is journalistic integrity? Why is it that we have to talk about this all the time? And no one is saying who's standing for delivery for billions and billions.
Who is standing for delivery?
We believe them to be sovereign wealth funds in particular. But I started talking about in so many of my videos that something's going on here because big money is now standing for delivery. Now, I don't know the exact percent of it, but I will tell you is that the amount of deliveries that we've seen in the past 15, 16 months here in COMEX, on COMEX, is akin to 4 feet of snow in Death Valley in July. And I guarantee you they're not going to open up snowmobile dealerships if that were to happen in Death Valley. It's an anomaly in every respect of the word. And what does it mean to stand for delivery? That means instead of being cash settled for your contract or rolling it over for another month in the future, they are saying, no, we want the metal right now. And it's delivered into the COMEX ecosystem. A lot of it leaves COMEX, goodbye, and never comes back. Where is it going? We don't know. Is it going to China? Is it going to the Treasury via the Exchange Stabilization Fund? Who's taking it? Is it Tesla? Is it Samsung? Is it Sony? Who's doing it?
Forget charts. This is about a physical heist. For 16 months straight, someone has been draining the COMEX, taking delivery of billions in silver. 68 million ounces in December alone, another 40+ million already in January. That's roughly 100 million ounces gone in 50 days. The mainstream media is silent. This isn't speculation. This is a coordinated physical grab, likely by sovereign players or governments. The usual price suppression tricks, margin hikes, paper shorts, aren't working because the buyer doesn't use leverage. They just want the metal, period. Gold near $5,000 and silver flirting with $100 are just symptoms.
I think that there is this fine line between, could it be Samsung, Sony? Could it be the government not telling us? If it's done under the Exchange Stabilization Fund, they don't need to get congressional approval. They don't need to tell Congress up front because it's for national security. Well, silver has now been made a priority for national security. And so I guess all I'm trying to say is that it's incredibly unusual, and the people at that level who are bringing in that kind of money, who have been following what the central banks have been doing, in my mind, that's all you need to see. And you can see that this is not a mania. It's not a mania because even though we're doing tremendous volume in business, it's not the volume that we saw during Silver Squeeze, where everyone was buying little bits, even a couple $1,000s, or where the public was starting to expand. Now, these are the people who we've worked with for a long time, or the people who have been watching you for a long time, or me, or others, who are finally saying, it's time to actually do something meaningful here. And we're seeing much larger orders. Our average order size right now is exponentially larger than it's ever been. I honestly believe that he got together with the, now again, I could be naive, maybe I'm wrong, but it just seems too coincidental that, you know, when he comes into office, before he even takes office, when he wins the election, all this gold starts coming back. And I think they got together with the banks and said, you idiots are so far short, it is an existential threat, and the rest of the world is buying it. So here's what we're going to do. We're going to tell everyone this is about tariffs, and your collusion that you've been doing for the last 30 years, you and the European banks and the banks in Canada, to maintain dollar supremacy, bond market supremacy, and to keep silver cheap for the military. Well, we're going to say that has to, you got to just send the bars back. Don't worry, it's a one-way tariff. This will end. You got to send it back. We got to cover, and we're going to reshore it. And it is not going to go back. And they've been bringing all this gold and silver back to the tune of billions and billions and billions and billions and billions of dollars worth every month, because he sees what's happening. And they understand that the global south is already ahead of us in reintegrating gold into the system, and we have to do it as well. And I think the same thing is true about silver, and that is why you saw all of these imports.
Right.
And ironically, they classify it critical.
Divide gold by the geological mining ratio, 7-1, and silver's true measure sits near $705. The guest says $200 by year end isn't crazy. This isn't 1980 or 2011. It's a structural shortage meeting monetary reset. The system that suppressed price for decades is breaking because someone finally called the bluff and asked for the metal. Whoever is taking it now will set the new price.
TD Bank is one of these morons who, you know, came out and they're one of the ones that are short. And they come out and they say to their public, they say, we enter short spot anticipating a dramatic reversal in prices as silver's devilish blow off, framing it negatively because they're wickedly short. Blow off top comes to completion. And it goes on to say, TD Securities entered a short position in silver futures in early January, betting the price would fall towards $40 an ounce. They placed a stop loss around $92 an ounce to limit losses if the price went the other way. What do you think happened last Friday? At a great expense to TD Bank, they got stopped out. If you play short in a market where you used to be able to do that and drive down the price not only through shorting, but through rhetoric, it would work and it wouldn't come back. Now, they knock it down, great. You got people that are standing for delivery for billions of dollars worth, say, thank you so much, TD Bank. We'll take all of that and watch what happens to the price. And we're going to stand for delivery too. So you need to come up with that silver, not just a paper, you know, a papered over payment instead of the real thing. It's an existential threat to these banks, and they proved it in a very, very short period of time, showing just what happens when physical demand overtakes paper manipulation. And that's why I've always felt that the only way you can successfully manipulate a market over a period of time, the way the Western central banks did, is to push it in the direction it's going. And they held it down. No one wanted it. But all of a sudden, there are some very sophisticated people and very wealthy people and very well-informed people, whether it be the central banks or whoever the hell is doing it here, or whoever has been draining the LBMA, and they're like, okay, fine, we'll play that game, and we don't play on margin, so go ahead and short it and watch what happens. It would look like what it looked like to Bear Stearns. And I've talked about this forever, the interview that Bart Chilton did with both Andrew Maguire and Chris Marcus, and then died shortly thereafter. I'm not saying that there is a correlation there, but he came out and said Bear Stearns failed largely because they held the largest short position in silver. This is the head of the CFTC, the Commodity Future Trading Commission, the commodity police, just like the SEC for securities. And he admitted that largely the reason that Bear Stearns failed was because they bet against silver and the price collapsed, and they let them fail. There were reasons behind why they let them fail. They were one of the only banks that didn't play ball with the Fed on something else years before, but evidently that was never forgotten. And so when the price rose dramatically, they collapsed. And this is when you get into the Jamie Dimon thing and all of the stuff that Bart Chilton talked about. It's one of the two videos that anyone who owns metal should watch. But the admission from the head of the CFTC that this is indeed what happened, to me, is exactly what will happen. And if you get a failure to deliver where the Fed doesn't come in and backstop, doesn't make Jamie Dimon and JP Morgan take that position, doesn't paper it over, you get a bank like like, for example, UBS, who realizes that the derivatives that they took over for Credit Suisse, same thing. Do you think they wanted to take them, or were they asked politely to take them? That those derivatives that they hold are worse than they thought, and you get a bank like that who has a failure to deliver, and the U.S. Federal Reserve doesn't come to the rescue, like the last time these things happened in 2008, and the United States had to open swap lines for the Swiss National Bank to bail out everybody. If they don't let that happen, and you see a systemic failure by one of these banks, a failure to deliver, well, these banks don't just trade in metals, they trade in everything. And you start to get a run on one of these banks, the systemic contagion reaction is like a house of cards that collapses. Could that happen? Yeah, absolutely. And I think that's the mistake that people make, to think that, well, they'll never let that happen. Who's they? And isn't it just possible that when you over leverage a system to the degree that the West has, where you rehypothecate or resell the same piece of metal over and over and over and over again, assuming no one will ever stand for delivery, but everyone does, and you can't get it, what happens? It's the kind of deal whereby they say when you go long, you can only lose what you put up. When you go short, you can lose everything. And it just keeps on going. And I think that is the lesson to be learned, that it could get very, very, very ugly. Now, is it probable to do that? I hope not. But it certainly seems we're getting closer to that point when David Jensen comes on our show and he says to me, Andy, London has 2 billion ounces in contracts that are outstanding for delivery against a 140 million ounce float, which he would himself tell you, well, I question that 140 million ounce float because they had to borrow money from China recently to make good on deliveries at a far less amount than that. So all of these things are, shrouded in a little bit of uncertainty, and it's a little bit opaque, but you can see it is beginning to break. Mm-hmm. That's the same reason the LBMA perhaps said that their market most of last year was T plus 8 weeks when it's a T plus 1 day settlement. Oh, we have a shortage of manpower and trucks. What you are seeing is a system that is fraying. And it started with the folks in the global south who became, motivated, sophisticated, coordinated, wealthy, and said, let's stand for delivery. Slowly, not too fast to blow it all up. Everyone says, why don't they just take it all? Because the exchange would blow up. Everyone would blow up and they'd cut off their nose to spite their face. But whether it be through an $8 premium over the Western price to slowly arbitrage, whether it be for standing for delivery, whatever it is, they're doing it slowly. You see it happening, and it's starting to accelerate. And TD Bank is a prime example. They put this trade in the beginning of January, and 10 days later, they're stopped out.
What does that mean when we see that this premium has persisted, driven by the strong domestic and investment demand for physical silver in China? What does that tell us?
Normally, when you have a discrepancy like that, Michelle, arbitrage resolves it, right? But it's not resolving it because the Chinese say, thank you. We'll pay more for your metal if you have the ability to buy it here in the Western paper and deliver it in physical in Shanghai. Thank you so much. And it's just that sucking sound that you hear is them really, I guess, trying to tempt and tempt the traders to deliver metal to China for a premium, for a profit. And the fact that it hasn't corrected and it continues to say persistent says that this is their plan. They're doing this purposely. Now there's a report by Van Eck. Now this is very different than James Rickards saying 24,000 or Mike Maloney saying 10,000 as a gold repricing. But here's what they say. They say, what do they say? Sorry, I have it right here. Okay. What if gold replaces the US dollar as the reserve standard? And I would argue that is what is happening in more so the Treasury, each country using their own CBDC, trading with one another over rails that are not SWIFT compliant or accessible, and using gold as the reserve status, as the reserve vehicle instead of treasuries. They say in this paper, our emerging markets bond team values gold by matching central bank money liabilities to gold reserves. implying 39,000 to 184,000 per ounce price. They talk about M0, which is the base level of money. And if they use M0, just to skip to the good stuff, liabilities divided by gold reserves at M0 is $39,000 per ounce weighted by daily FX turnover. If central bank liabilities are divided into M2 divided by gold reserves, $184,000. They say using global M2, we calculate the global price of gold that equalizes M2 is around 100,000 per ounce. Weighted by daily FX turnover for our sample, the gold price that equals M2 is 184,211 per ounce. What I am saying to you is that I have believed this for a very long time, that gold will be reintegrated as the de facto reserve status, the reserve vehicle, the preferred reserve vehicle of the world. And it's happening in the global south now. And if Judy Shelton is right, and she came on your show and mine and said that she believes, and Trump told her that he will peg the back end of the bond market to gold with the Genius Act working on the front end, if indeed that were the case, right? If you have to sell a $20 million bond in 30 years, deliver $20 million in gold in 30 years at 5,000 an ounce versus 184,000 an ounce by the time you get there, you sell it at 5,000 an ounce, and you're delivering it when it's $184,000 per ounce, you've just massively, exponentially cut the number of ounces you have to give. What have else you done? You've massively devalued the dollar.